There's a lot of whistling past the graveyard. I mean, the stock market is still, greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. We're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. We are in a recession. The U.S. is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. We'll see what third quarter is going to be, but it may be prolonged. It may get worse. Europe is in a recession, based on the latest data. Japan is in a recession. China looks like they're in a recession. They reported their most recent growth figures of 0.4% for the second quarter, not 4%, but 0.4%. Versus compound growth of over 10% for about 30 years. So they're admitting 0.4, and I have to believe that's negative. So we're really looking at a global recession. Now, a recession or even a depression, which it may turn into, is not the same as a financial panic. You can have panics without recessions. We saw that in 1998, 1987. You can have recessions without panics. We saw that in 1990 and 2020. The dollar generally does rally in a financial panic. That's correct. And it does so because people want the best assets they can find. They're like, the best description I've ever heard of a financial panic is everybody wants his money back. It doesn't matter what you're in, get me out, sell it, whatever. I want dollars. Well, when you get the dollars, you got to go buy something. So you can leave it in the bank, but banks are risky. I mean, the problem in 2008 is the banks were failing, and that didn't quite happened in 2020, but it absolutely happened in 2008. So they buy treasury bills. They buy treasury notes. They're the safest assets. They may not want them for long, but you can buy a 2-year treasury note or a 6-month treasury bill. You're not in it that long, and your money's safe. So there is a demand for dollars somewhere around the world to buy that really good collateral because it looks like a safe haven relative to everything else that's falling apart. That's not exactly what's going on today, but it's related. But we are in a recession. Now, the recession should damp down the inflation. It hasn't yet. Inflation's high. There's no question about it. We see it in the data. You see it at the gas pump. You see it at the store. But that may trend a lot lower very quickly, but not for good reasons. In other words, you say, well, what's the Fed doing about inflation? Well, they really can't do anything about it. The inflation is coming from the supply side. The inflation can come from probably a lot of places, but 2 places in particular, supply side and the demand side. Supply side inflation is when there are shortages, there are bottlenecks, there's supply chain dysfunction, people run out of stuff, there's not enough fertilizer, not enough water, not enough truck drivers, ports are clogged, you can't get the input A to make item B, so you got to shut down assembly line because you can't get titanium from Russia to build Boeing aircraft. It's complex, it's huge. It's the subject of my next book, Sold Out, which is coming out in November. But supply chains are breaking down in many different respects. And prices go up as a result. But the other kind of inflation is called cost push inflation. The other kind of inflation is demand pull inflation. This is when consumers change their behavior. They get it in their heads like, hey, prices are going up, they're getting out of control, I better go out and buy that thing, And this is what we lived through in the 1970s, and I remember very well. If you were going to buy a refrigerator, a new car, a dishwasher, whatever, you'd say to yourself, I better go buy it today, because if I wait 3 months, it's going to be higher, or 6 months, it's going to be a lot higher. So of course, that just pulls demand forward, and it creates excess demand relative to supply, and then prices do go up and it feeds on itself. Next thing you know, bosses are handing out raises because of inflation, people just spend more, et cetera. So the Fed can do something about demand pull inflation. They can destroy demand by raising interest rates, raising mortgage rates, credit card rates, and everything else. They can't do anything about supply inflation, the supply chain inflation, cost push inflation. They can't do anything about it. The Fed doesn't drill for oil. The Fed doesn't drive a truck. The Fed doesn't run a cargo line. The Fed doesn't mine, titanium in Russia. They can't do anything about any of those things. So, then you get into, is it really inflation? Well, inflation means prices are going up. But if they're going up for that reason, two things are true. One, the Fed can't do anything about it. Two, it will probably run its own course in the sense that, if prices go higher, there's going to be a lot less discretionary income. You still got to put gas in your car, and you still got to put food on the table. If those two things have doubled in price, and they have, then you have that much less left over for everything else. You'll say, well, I'm going to skip the vacation, skip the concert, skip the restaurant, skip a lot of things, new furniture, whatever. I'm not going to buy any of those things because all my money is going to buy gas and food. So you still get the gas and food, but not more. You just pay more, and the value of your dollar goes down, real wages go down, and you're not spending money on anything else. That'll put the economy in a recession real fast. That's happening. We're in a recession. I already said that, but it will get worse. Now, here comes the Fed, right? Always a day late and a dollar short, or maybe too many dollars, but they always get it wrong, is my point. So what are they doing? Well, they're saying inflation in the numbers. They don't really seem to distinguish between supply side and demand side. And they're going to the Volcker playbook, raise rates, raise them. That can get inflation under control, but only at the cost of a much worse recession, higher unemployment, business failures, people out of work. I say, who cares what the price of gas is if you're sitting home unemployed? Everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. It's not coming, we're in it. But we're in a recession right now.